Hi everyone. So last month Adaniji took a loan of roughly 6,000 crore from SBI to start a copper manufacturing business. This month they are in talk to raise roughly 14,000 crore loan again from SBI to start probably a new business. Now let me take you to a very interesting article which talks about the fact that India's willful defaulter loans have risen up to roughly $2.2 trillion. This is a 10-fold increase or a 10-time increase over the last 10 years. And if you delve into deeper details of this article, what you will figure out is that 95% of these loans have been given by public sector banks. Out of this, 30% of the loans have been given by SBI alone. So on today's video, I'm going to talk about ADANI Bank of India. I'm going to talk about SBI or State Bank of India, and will speak about with you in 4 simple points as to, is this situation worrisome that something like SBI is giving so much loans to a big conglomerate? How securely have they given loans in the past? What their track record has been like? And going forward, if you are an investor, should you continue to invest your money in something like SBI? Also, a humble request before starting the video that please press the like button so that these type of topics get out to more people. They are made aware of what is happening with taxpayers' money. It is a very important aspect for all Indians to get educated as to how their money is being spent by the governments. Just to give you some context and starting a parallel topic here, that Air India, when it was making a loss, it used to make a loss of 20,000 crore per day. So that was a big loss, and who was paying for it? We, the taxpayers, were paying for it. So therefore, please ensure that whenever you are seeing these type of things, you share these type of videos. So with that said, let us get the story started, and I will speak in 4 very easy to understand points. So point number 1 is some historic context around SBI loans and what type of engagements they have been a part of. While SBI has given a ton of loans to a bunch of different people, there are 3 standout cases that are the most talked about cases in Indian media as well. So let me show you a quick history of these 3 cases. So the first case is that of Mr. Vijay Mallya. So Mr. Vijay Mallya took a loan of roughly 9,000 crore, and despite all the turmoil that has happened, he has so far paid only 58% of that money, of that 9,000 crore. The rest of it is a loss to the exchequer. Why is that? Because the lead financer on this loan was the SBI consortium, and SBI had a lot of exposure to this particular loan. So these type of loans will fall in the willful category of defaulters. So what is meant by exactly willful defaulters? So willful defaulters are people who can technically pay the loans by selling off their assets, but they are choosing not to pay those loans by exploiting some kind of loopholes. Now comes the second example, which is one of the most discussed scams of India, which is the ABG shipyard scam. Now here is the list of banks and their exposure to ABG shipyard, and here again you will see SBI in one of the top 3 lenders that had the most exposure to ABG shipyard. Now, third most talked about case was of Nirav Modi and Mehul Choksey. And here you would say that, okay, that was Punjab National Bank, not SBI. So here is a very interesting article. And I was talking about this article with my wife just a while back, and she could not believe it. And honestly, I don't know if this story is true or not, but here is the study that was done by Times of India. And what they ended up saying was that they talked with Nirav Modi. And Nirav Modi said that SBI was his preferred choice of lender. But he went to SBI, he told them that, hey, I'm a big jeweler, I need a loan. But the SBI worker there said that, hey, we are on lunchtime and only Swiggy people are allowed. If you don't trust me, just check this article. So SBI got saved here, and they said that they did not have any direct exposure to Nirav Modi's scam, and they had indirect exposure to him, largely because of the fact that the worker was probably on a perennial lunch. So the bottom line remains that whenever you see a large NPA problem looming somewhere, you will have SBI's names associated with it for one reason or the other. So now comes the second point, that why these public sector banks, they undergo such large scale defaults. There are multiple reasons for the same. I will not get into political side of the equation because, of course, politicians appoint directors, all that stuff. Everyone is able to follow along that part of the equation. But I will talk about more systematic issues without making this video political. So one of the key reasons why there is so much shadiness with public sector banks is simply because of the fact that the operational matrix or KPIs or key performance indicators are not set. A classic case in point is Punjab National Bank and Nirav Modi scam that happened. So here is the entire article, and I will read it with you. So basically it says that in PNB fraud case, they are referring to the Nirav Modi scam case, thereby allowing officers to clandestinely issue letters of undertaking to Modi's companies and confirming them with counterparty banks overseas through the SWIFT system. So the bottom line is that there was a poor linkage between the SWIFT system and the core banking internal software. So as a result, the alarms were not raised at the appropriate time, and the Nirav Modi scam took place. Now, this is slightly more complicated stuff to get into. What I would request you to do is, please watch a series called as 1992 Scam. You would understand more about the letter of undertaking issue. So one of the key reasons why these type of scams keep on happening with public sector bank is that their operational parameters are not optimized similar to the way it is done at top private banks. Now you might turn around and say that, you know what, Akshat, the ABG shipyard scam, I can see the name ICICI Bank also there. True, but there are 2 points there. Number one, if you take a look at the meta study means the big study, then you will clearly see that 95% of willful default loans still comes from public sector banks, not private banks. Second key point is the timing of the ICICI and ABG shipyard scam. During that time, there were corporate governance issues with ICICI Bank, and you had the Chanda Kochar problem also, where she ended up issuing loans to her own husband for business. So while it is true that it is almost impossible for a bank to completely eliminate the bad loan problem, there are systematic issues with public sector bank that we have to acknowledge, simply because of the fact that if you look at the meta study, almost 95% of the data points to the fact that public sector banks are the ones that end up issuing loans to people who become willful defaulters eventually. Now, the second key reason is there is lack of incentive and accountability. For example, here is a statement by Dr. Raghuram Rajan, and he writes in his book, I Do What I Do. Today, a variety of authorities monitor the performance of public sector bank. It is important that we streamline and reduce the overlaps between the jurisdiction of authorities and specify clear triggers or situations where one's authority oversight is involved. So basically what he's trying to say is that there is a lot of overlap between different functions, and it is very difficult to assign accountability to different people. So whenever any scam is uncovered, a lot of investigation takes place, a lot of new metrics and guidelines are given, but nothing is followed in the spirit per se, simply because there are a lot of overlapping authorities that are involved in terms of running a public sector bank. Now, third, more systematic issue is that public sector banks do not focus on risk mitigation. They are too focused in terms of increasing their loan books. For example, right now, there is a lot of celebration-oriented news at SBI that, hey, our loan books have grown, our profits have grown. All that is great. But having so much exposure to Adani debt, if you want, I'll make a separate video on Adani debt. Let me know in the comment box. But the point remains, it is fairly commonsensical that if a person or a company is taking and building entire businesses or series of businesses purely financed through loans, then at least one bank should not be overexposed to that particular conglomerate. Now, can I show you some data and numbers regarding how much debt do Adanis have from SBI? And that data is unfortunately not released, which is very interesting. And let me talk about a little bit by showing you this graphic. So you can see that this is the total write-off of amount that has been done by SBI in different years. So you can categorically see that this number had been going up until financial year 19 and 20. For example, the total write-off was roughly 46,000 crore and the total recovery of that amount was literally less than 10-12% of that. Now, when you go and ask banks like SBI that, hey, can you give a list of these people who are defaulting and not paying these loans and whose loans are you writing off? The banks will not give you information. But if this happens at an individual level, if you and I take a loan from SBI and if we default, then banks sometimes publish our names in the newspaper. So this is precisely what is written in this particular article. So to cut the long story short, in order to manage the risk, any bank should be sensible in terms of not overexposing itself to a particular party, especially if it is taking so much loans after loans after loans. This is very commonsensical. Number two, you cannot question the banks also because that list is not released as to how much loans they have given or written off for every single entity. So this becomes like a complex problem to deal. So let us move on to the third section and let me speak about the risks associated with SBI's loans, at least what I could find through public information. So first and foremost, we spoke about this chart where the write-offs that were done by SBI, they were rising up until 2019. Then comes the natural question that, hey, what happened in 2020 because this number came down? So something magical happened, or did the asset quality improve? The answer is no. The regulations by RBI was changed around how to define NPAs. So as per this article, you can categorically see that RBI changed the period of defining an NPA from 90 days to 180 days. So due to the fact that the period of defining NPA was increased, fewer NPA defaults will happen during that period of time. Now, very interestingly, in 2020, there was a mispricing risk which was talked about by the managing director of SBI. So here is a statement from him and I will read it out with you that though banks have tightened the underwriting standards, the surplus liquidity in the system may push banks to a situation where they end up mispricing the risk. So what does this simply mean? So I'm oversimplifying the story. It simply means that post 2020, a lot of money was printed into the economy, or a lot of liquidity was brought into the economy. So banks had a lot of money to lend out just to stimulate or re-stimulate the business activity. This was point one. Number two, the banks were mandated that go out and give more loans. And guess what? As point number three, there were entities like Adani's that ended up taking and availing more and more and more loan from 2020 onwards. So what happened in this game was that the bank chairman himself has alarmed the situation that, hey, the risk might go up associated with these type of loans. Now in 2022, something strange is happening with SBI. First and foremost, their stock price is skyrocketing. In fact, if you check the current numbers, you can categorically see that it is trading almost at its all-time high. This is despite the fact that if you go and compare it to something like HDFC, which is a much cleaner bank, its stock price is trading at roughly 20% discount right now. Now you might have read a series of positive news that bank profits have grown, revenues have grown, loan books have grown, they are lending out money more. Yes, they are lending out a lot of money, but at what risk? This is something that no one is talking about. So fueled by all this optimism, and given the fact that when they have lent out to businesses like Adani's, they themselves have gone on to massive expansion and everything is going well as of now. So there is nothing to worry for SBI as per the current situation. They are venturing into more unsecured loans for the time being, and here is an article to prove it. So what is the net story that I am trying to tell you? It can be understood through this particular flowchart. So basically, the way the back-end structure is working is that banks like SBI are being pushed to give out more and more loans. This has been happening due to legitimate purposes, because when the COVID situation was there, the world was stopping. So government had to pump in a lot of money and SBI had to lend out. So they did that. There is no problem up until this point. It was necessitated. But now this is turning into a habit, and there are two outcomes that can take place. So more loans that are being given out to end businesses, if these end businesses are able to survive and win in the economy, so SBI will keep on getting its money and its loan book will get strengthened in time. But option two is horrific, that if these businesses lose, then they will default on their loan. There will be a lot of write-offs that will be undertaken by SBI, and that can lead to very bad future for public sector banks. So this brings me to the final section where I will talk about investment related points associated with SBI. So first and foremost, is SBI safe right now? The answer is I don't know. It is for investigation agencies to investigate. But I, as a common citizen, can just look at the publicly available information and can draw my own inferences that the game that SBI is playing right now, it is a highly dangerous game, and people who are putting their money on SBI stock, they stand a lot of money to lose in case the situation turns bad. Second key point, that will the SBI business get completely demolished if, for example, Adani's business fails? The answer is no. SBI's loan book is huge. It is a very big bank. It can absorb the shock of even Adani's failing. In fact, let me re-qualify my statement. It will not be SBI that will be absorbing the loss. It will be the citizens of India. And do we have the capability of absorbing such losses? The answer is yes, we will be able to absorb it. So SBI will continue its operations as it is. Nothing is going to change there. Point number three, if you are looking to invest your money in HDFC Bank or SBI Bank, again, I will take you back to that same graphic that SBI right now is almost hitting its all-time high. The risk reward equation does not make sense to me. This is not an investment to sell, buy, etc. I'm just simply showing you facts. If you compare it with something like HDFC Bank, which is a cleaner bank, you will hardly see HDFC getting involved in these type of murky situations. Their books are clean. They are trading at roughly 20% discount. Please understand how the banking business works. One part of the equation is increasing your loan book, that you are giving more and more loans. That is great for the business, as long as the part 2 of the equation, which is recovering of those loans, also happens. It should not happen that your loan books are growing, that these loan books backfire after 5 years when the people whom you have lent out your money to are not able to pay you back. This brings us to the final point, that Akshat, you have been bullish about Punjab National Bank. Then why such double standards with SBI? So first and foremost point there is that I am not saying that Punjab National Bank will become the next HDFC Bank. It's a swing stock for me. Again, not a recommendation for you to go and invest in Punjab National Bank or sell Punjab National Bank, nothing of that sort. I am simply trying to point the fact that Punjab National Bank has been a swing stock for me. Right now, it is trading at a massive discount, and the risk reward equation makes sense because of the price at which Punjab National Bank exists. Can some type of fraud happen at Punjab National Bank also? The answer is yes. Can some type of fraud happen in SBI also? The answer is yes. But SBI from a pricing point of view is very, very high. Punjab National Bank is not that high, especially if you compare its current market price to its book book value. So going forward, how do I see the situation playing out? If everything is hunky-dory in the economy, if the economy keeps on doing well, then Adani's will grow, SBI will get his money back, and everything will be good. But on the flip side, if there are economic tremors and if the business of Adani's go under for some reason, then SBI seems to have a very large exposure to Adani debt, and that can prove disastrous for a bank like SBI, at least in the short term. I hope you enjoyed the video. Now I'm going to have lunch. Please like and comment on this video, and I will see you soon.